In today's video, we'll be discussing the recession and the indicators that suggest a potential economic slowdown. Our focus will be on four main topics, starting with GDP. We'll also cover unemployment rates, the well-being of the American consumer, and the inverted yield curve. The green bar represents the inflation-adjusted GDP growth of 2.9% in Q4 of 2022, which is slightly lower than the 3.2% in Q3 of the same year. In comparison to the 6.9% in Q4 of 2021, the current growth rate is significantly lower. The chart displays a noticeable economic decline during both the Great Recession and the pandemic. The GDP, gross domestic product, is the total value of all goods and services produced within the United States in a specific period, usually a year. It's a measure of the size and health of the U.S. economy and is one of the most important indicators of economic performance. The USA GDP includes all the economic activity that takes place within the country's borders, whether it's performed by U.S. citizens or foreign nationals. The USA GDP is usually reported in real terms, which means that it's adjusted for inflation to provide a more accurate picture of economic growth over time. The United States has the largest GDP in the world, with around $24 trillion, with China, Japan, Germany, and India following as the countries with the next highest GDPs. I don't think that the current recession will be as severe as the previous ones, but it's clear that we haven't reached the worst of it yet. It's worth noting that the smaller red contractions in Q1 and Q2 of 2022 were primarily due to the trade deficit, where exports add to GDP and imports subtract from it. During the pandemic, our exports decreased while imports increased significantly. In this latest GDP report, the growth was driven by strong consumer spending, indicating that consumers are still spending at healthy levels. Consumer spending typically accounts for 68% of GDP, which is back to pre-pandemic levels, and in Q4 it reached 70.6%. However, the weakening housing market and businesses' cost-cutting measures have contributed to the GDP's decline. As of January 1, 2023, the economy had a positive start with an annual growth rate of 2.9%. However, it's evident from the graph that we're currently on a downward trend and losing momentum. Confirmation of this trend can be heard from company earnings calls in the stock market, where there's a recurring theme of a slowing economy and decreasing demand. Analysts predict that the GDP for Q1 of this year will be around 1.5%, which is a significant drop from the previous estimate of 3.5%. This drop is significant considering the U.S. GDP is approximately $24 trillion, and a 2% difference in GDP is considerable. Although the data for Q1 is not yet released, we can see from the trend that we were at 2.9% in Q4 of 2022 and have since been on a downward trajectory. The Federal Reserve's objective is to use their restrictive monetary policy to bring down inflation while only slowing down the economy rather than causing an economic contraction. In simpler terms, the Fed hopes the economy will continue to grow but at a slower pace. This is referred to as a soft landing, which does not imply a mild recession, but rather maintaining positive GDP. Luke Tilley, the chief economist at Wilmington Trust, believes that if the job market remains strong and there's sustained consumer spending on services, along with no significant cuts in capital expenditures by companies, it would support the idea of a soft landing. Many individuals share this view and believe that the worst is behind us. However, there are those who remain skeptical of this optimistic outlook, citing various economic indicators. While no one wants a recession, it's important to stay grounded in reality. As adults, we can handle the truth, and we don't want to be caught off guard or ill-prepared. Therefore, it's important to have an open and honest conversation about the state of the economy. One area of concern is the labor market and unemployment. Real wages have been declining, and the government has reported a decrease in the purchasing power of the average American. Wage growth has not kept pace with inflation, and this trend is expected to continue. Adding to the concern, unemployment is projected to rise. The trend of job cuts in the tech sector is on the rise, although tech companies prefer to call it right-sizing instead of layoffs. In 2022, the tech industry saw 97,000 job cuts, a significant increase of 650% compared to the previous year. Typically, companies implement job cuts in multiple rounds, indicating that more job cuts may be expected. Notable companies like IBM, Salesforce, Microsoft, Alphabet, Google, and Amazon have already announced significant job cuts. This trend is now spreading to other industries such as Dow Incorporated and 3M, who've also announced job cuts due to weakening demand. Finance and banking sectors have also been affected, With Bank of New York and Goldman Sachs announcing job cuts, retailers like Bed Bath & Beyond have also been affected, and with more bankruptcies likely to happen, more job cuts may be on the horizon. I think it's important to address the issue of misleading headlines and unemployment reports. While the official unemployment rate is cited at 3.5%, the U.S. Chamber of Commerce recently reported that we have 2.95 million fewer workers compared to pre-pandemic levels, as indicated by labor participation rate. This data is not hidden, but it's important to consider that if someone can't find a job for an extended period, they're no longer counted as unemployed. That being said, it's also worth noting that many seniors have chosen to retire early, for better or worse. It's important to keep these factors in mind when interpreting headlines about unemployment. Despite this, it's expected that unemployment will continue to rise, with projections ranging from 4.4% to 4.9% this year, which could result in over 1 million job losses. If this trend continues into 2024, the number of job losses could be even greater. The strength of the U.S. consumer has been propping up the GDP, but the outlook for this year is not positive. Real wages are expected to continue declining, leading to a decrease in purchasing power and a rise in unemployment. Additionally, retail sales have been declining as Americans are cutting back on spending. In December, retail sales fell by 1.1%, following a 1% drop in November, according to the U.S. Commerce Department. Moody's vice president has noted that higher prices and interest rate increases are starting to take their toll on consumers, and there are cracks appearing in their resiliency. Moody's expects consumers to be more selective in their spending and postpone purchases. Moreover, the data shows that more Americans are relying on credit cards for day-to-day expenses, and 46% of credit card holders carry a balance month to month, which is now more expensive due to higher interest rates. The number of households defaulting on credit card payments is on the rise, and many are not adjusting their spending habits to the current economic situation. It's important to take notice of this trend and not let it happen to you, as the economic situation is expected to worsen before it gets better. Despite the mainstream media's narrative of a soft landing based on the strength of the U.S. consumer and labor markets, the data indicates a weakening of the U.S. consumer and a predicted rise in unemployment, coupled with persistently negative real wages. Therefore, it's reasonable to be skeptical of this narrative. Additionally, the bond market is signaling a recession as the yield curves are inverted, which has preceded every recession since the 1960s. While it's not advisable to rely solely on the inversion to predict a recession, it's an additional warning sign, and the yield curve has accurately predicted the last 6 recessions. To conclude, the estimates for the U.S. economy this year suggest that real GDP growth will be 0.3%, CPI inflation will reach 4%, unemployment will be at 4.5%, and the 10-year Treasury yield will be at 3.8%. While I do not think we will have a soft landing, I do not believe this recession will be as severe as the Great Recession. In terms of inflation, I expect it to remain around 5%, and the Fed will need to take a hawkish stance. Therefore, the situation may worsen before improving, but it's not the end of the world, and there will be economic opportunities during turmoil. Be prepared, avoid financial trouble, and take advantage of opportunities that arise. When assets such as stocks, cryptos, and real estate fall in price, that's when they can be purchased at a good value. I'll keep you updated. Please subscribe. Thanks for watching. Until next time.